Welcome to Liquidity Event Lessons. I'm Mike Ross.
I'm Ryan Ross.
Liquidity Event Lessons is all about what you should be thinking about and doing both pre and post sale of a business, certainly for the business, but really for yourself.
In this episode, we speak with Nick Rosado of Kim Rosado Partners, which is a tax firm based in San Jose, California. And they focus specifically on helping companies craft tax strategies with the IRS's rules in mind. These guys are both former IRS guys, and so they come at it from that perspective. Nick talks about tax strategies, best practices for selling a business, what things people are doing that they shouldn't be doing, and much more. So enjoy this conversation with Nick Rosado. All right, Nick Rosado, thanks for coming on. Could you just give us a little bit of background about who you are and what you do?
Sure. So I'm Nick Rosado. I'm a tax attorney. I'm currently a partner with Kim and Rosado LLP. We're a small tax firm based in the Bay Area. We have offices in San Jose and Walnut Creek. But prior to that, both me and my partner were attorneys for the IRS Office of Chief Counsel. We would represent the IRS in court and advise IRS employees, revenue agents, revenue officers on legal aspects of the cases that they were building. In particular, I was a fraud coordinator for the San Francisco field office of the IRS Office of Chief Counsel. So I would advise field agents on all fraud investigations taking place in Northern California. There are always a lot of tricky legal issues when the IRS is trying to develop fraud cases. So that's something I did for about 7 years before starting my own practice and going into business with my partner. And currently we advise clients on mostly tax controversy work. So people who are usually already in trouble with the IRS, we help navigate that situation. We do advise clients before they get into trouble, ideally, and the things that can come up and how to avoid issues with the IRS. We provide legal advice to people with difficult questions of tax law,
I feel like is it often that they come to you and say, if I were to tell you that I might have done this, but I haven't done it, but if I did, what would you say? Does that ever happen?
It definitely happens, and I have to reassure people that yes, everything you tell me is confidential and privileged. So if you can tell anyone, you can tell me.
Yeah. I have a brother that did this, and he's okay, right? All right. So we just got an understanding of the scope of your practice, and before Dad has a question about like who hires you and why should they hire you. Before we go into that, I'm really curious, like, how did you guys go from working for the IRS? And I don't want to say this is like the opposite side, because it's just like offering this, this is what they're probably going to be asking you. Is that right? Or how did you guys identify that there was a need in the public sector versus the IRS? IRS is private sector, I guess. No. Opposite.
Yeah, so it is definitely the opposite side. So we're across. When we're in court, we're on the other table. The IRS attorneys now are they're opposite of it. So it's certainly what we're doing is opposite. But it's all part of the same system, and we're actually assisting in helping people to be compliant and to avoid those issues. So in a sense, it's opposite, but it's all part of the same system.
Well, now you guys understand the system, so you can say like, this is what you need to know in order to be compliant.
That's right, and then that saves everyone a lot of trouble and work. So, but I guess how we came to it was we were on the government side for a long time, and we would come across practitioners representing taxpayers that maybe we didn't think they were doing such a great job. So we thought that there was opportunity in the private sector if we were to open up our own firm and be able to provide, I think, more the inside knowledge that we had gained and how the procedures and everything was in place. Most people, if they haven't worked there, they don't know exactly all those procedures and how everything interacts. And so I think we thought we could give a higher quality service if we were to come outside. And so we took the plunge.
Mm-hmm.
So Nick, in that answer, in that description, you hit multiple questions that I'm going to ask you, but let me start with maybe the easiest, which you've covered a little bit. When do people typically hire you? But more important, when should people hire you?
Right. So typically when people hire us is when they're in pretty serious trouble. So when the IRS has either initiated an audit, and I mean that's even a good time to hire. Once you get the initial audit letter, that's great. But usually it's when things have gone sideways, when the IRS is proposing huge adjustments, maybe when things have ratcheted up and it's looking like there may be more serious issues other than just some simple some dollars that are owed. So usually it's that situation. So sometimes people have huge balances that they owe to the IRS or to the state agencies, and they want to correct it at that point. So that's most often where we come in. When should we come in? Ideally, what I like is helping people organize and get the business set up and structured correctly and get the right processes in place. So I think day one, when the business starts, that's certainly a good time to bring us in, even if they're working with someone to set things up, maybe just for us to kick the tires and make sure everything looks good. Because if everything's done right in the first place, there's never any issues down the road, right? So.
Is there a kind of a level in terms of earnings or sales or something in the case of a business where it becomes strategically good to do that, and below that it's just not worth the time and effort? Is there a threshold there somewhere?
Yeah, I mean, it's just having a quick look at a business. It's probably worthwhile for anyone who's seriously going into business. So even if the business maybe isn't generating income up front, it's usually a good investment just to get everything in place, because you never know where things will go. So, but I guess certainly for more in-depth issues, and I mean, certainly hiring an attorney is not an inexpensive proposition. So, you'll want to, more successful businesses, it'll be easier to eat some of those costs. But I don't think that, especially what we do, we're not a big firm, so I don't think that we're only looking at the bigger businesses. I think everyone could use at least a consultation and a conference just to discuss things.
Regarding like selling a business, so the audience for this is going to be people that have recently sold, or maybe they're looking at selling their business, right? And with those kind of clients in mind, do you ever find yourself in a situation where someone was going to sell the company and things went awry?
Well, I think, and I think looping back into some of the things I was just talking about, often selling the business, you've kind of locked yourself in to some of the tax results, because you've already, you've structured the business is structured as tax aspects from day one, that once you're selling the business, that's going to lock you in. So, I think understanding in the beginning the life cycle of the business, what you want to do, and that's going to help you with the business structuring, because how the business is structured is going to have a big role in how you're going to be taxed at the end of the day. Because sometimes I've come across it, people think they're selling a business, they're going to pay capital gain, and sometimes based on some of the aspects of the business, and how maybe the buyer wants to structure the purchase. There may be ordinary income involved, which is taxed at higher rates. And then there are a lot of issues with California, depending on how the business is structured and how the sale is structured, with California taxes that might be higher than people would anticipate. So, certainly sometimes people get a number and they think, yeah, this is great. But again, we always, and I always tell people, you have to think about what's the after-tax number, right? It's not what's coming in, it's what you keep, right? So.
So reflecting upon this, my sense is that best practices is bring in someone with your expertise, if exclusive for a consult 2 or 3 years prior to a sale, and just get either a thumbs up or a thumbs down in terms of the existing structure, number one, and then describe to them really the situation in terms of, okay, I want this to be a capital gain and not ordinary income. Another one that I've come across just recently is someone anticipates selling a business and then moving from California to Texas. And you got to get the timing right, and you got to get all the behavior right. So my sense is best practices is work on this early and thoroughly and think through the next phase of your life before, and spend a couple bucks then, so you don't have to spend bucks later. Is that a good way to appraise it?
Yeah, that's definitely a good way. So if this is something, even if it's not imminent, if it's something down the road, that you think, hey, at some point I'm going to want to exit, you have to start thinking about what that's going to look like. And the sooner you start, the better, right? Especially, I mean, if you're thinking about, hey, I don't want to be taxed by California, that's a very dicey proposition. You have to start, you have to start working on that, well ahead of time. So those are considerations that, yes, you have to start very early. And I think it's, that's how I always approach things. If I think, hey, maybe, there's a few different options. Let me see what those how they may play out, right? And let me do the research and figure out what option A, option B, option C might look like, even though I don't know exactly which way life is going to take me.
Are there any things that you're seeing them do more in terms of structuring their business? Maybe it's the state that they're based in that they shouldn't be doing, right? Maybe it is the state, or maybe it's just like the way, if it's an S corp versus a C corp versus LLC, or like, can you point to anything that you're seeing like, oh, you really shouldn't be doing that because of this, that definitely is going to lead to this bad situation? Anything stick out? Or maybe like international businesses, right? I don't know if you guys deal with international, but like maybe there's like a high profile thing that you can point to, like, oh, they should have done this differently.
Well, sorry, I mean, once you step, out of the U.S. and you structure anything out of the U.S., I mean, there's certainly just a lot that you have to be aware of. So a lot of what we do is issues with international structures that people just weren't aware of, reporting requirements for those international structures. So certainly once you step foot out of the country, open up financial accounts, invest in mutual funds, organize businesses out of the country, you certainly have to pay attention. And that's always a huge issue, because the penalties for not reporting international, you just have to report. So just not filing those forms and reporting these things can lead to just astronomical penalties. So that's certainly always a big issue. And I think that's something that we deal with a lot, I think.
Are there any specific like industries that are more susceptible to these kind of, I don't know if they're regulatory requirements, but are there any industries that are like, oh, if it's banking, then you're going to want to make sure you definitely do this. If you have an account in Bermuda, or if you're tech, it's a personal identification information issue, right? Like GDPR, you got to watch out for this. Are there any industries that have specific eccentricities, perhaps, that are like unique to that industry?
Yeah, I think, just I guess going back to the international aspects, some manufacturing companies will often set up subsidiaries overseas without maybe knowing about all the requirements. In the Bay Area, certainly technology companies will try to get intellectual property or other things like that overseas, and that has very specific requirements that you have to follow. So yeah, I mean, it's with the IRS and income tax reporting, there's usually not industry specific things that you have to watch out for, because the income tax is the income tax. But certainly structuring is always, that's always an issue for every business.
So in a scenario, I'm 3 years away. I know I'm going to sell the business. I'm going to sell it in 2 or 3 years. I may even have some buyers identified. In that particular, and it's industry agnostic, in that particular circumstance, from a tax attorney's perspective, would you describe there to be any best practices or things to avoid in that scenario?
Well, yeah, I mean, so you just have to start, you have to look at what your business structure is, look at what the buyers, especially if you have buyers identified, I guess, how do they want to structure things, right? So, I mean, certainly buyer wants to structure things as an asset purchase usually, while seller will want to structure things as a stock sale, depending on the circumstances, right? So you have to look at your own tax aspects and say, hey, maybe an asset sale is going to result in all capital gain anyway. So for me, I'm agnostic on, it doesn't matter which way it goes. So maybe the buyer is interested in doing an asset sale, but maybe that the buyer does want to structure a stock sale. They want to continue the actual business the business itself, and then maybe think about ways to structure a stock sale as an asset sale anyway, so that the buyer can get stepped up basis on the assets, as long as it doesn't affect you. So as a seller, though, you have to think about, well, if I sell, if I structure it as an asset sale, is this going to result in capital gain, or is there going to be some ordinary income because maybe I'm selling inventory and things like that? So then you have to think about, maybe it's better for me to structure things as a stock sale, and how can I get there, right? And then do I ask, if we're going to do an asset sale and there are negative tax consequences for me, do I have to ask for more, right? Do I have to ask for them to bear some of that cost that I'm going to incur to sell the business, because I'm not keeping as much money as I would want on the sale, right? So yeah, looking at your tax aspects, looking at potential buyers and what they're going to want, and then trying to find a solution for both parties that's going to leave more money in everybody's pocket.
So shift the circumstance, Nick. Okay, the person did whatever they did. Perhaps they were thoughtful about it. Perhaps they were getting good advice. Perhaps not. Now the transaction's been done. It's done. Have you run into situations where folks have come in to see you and said, look, I did all this stuff. The transaction's done. And because of things around that transaction, they need to take action now to solve a problem or two. Do you run in, is there post-transaction best practices, post-transaction lessons learned that you've picked up over the years?
Yeah, so, certainly it depends on the circumstances. So sure. I guess we can, probably the most egregious things that I've seen are large employees and large liquidity events, receiving ISOs, or stock options that they're recognizing that they're paying tax on, and even though they haven't received cash, they're receiving income based on the grant, but they don't have any cash in pocket, and they therefore have a huge tax liability. They hold on to the stock and then it crashes. So I've certainly, and I come across it a lot where someone may have had millions on paper just the year prior, and now they have nothing other than $1 million tax liability that they can't pay now. So that's certainly something that employees need to be careful in these situations if they're receiving ISO. It's usually with ISOs because there are AMT issues there that people have to be careful with. So that, as an employee, you certainly have to be careful. And then, as a business owner selling a business, not paying attention to tax aspects and maybe having large ordinary income and maybe even capital losses on the sale based on how things shake out, resulting in, I have a lot of ordinary income that I'm paying tax on, but I have capital losses that I can't use to offset it because maybe there are a lot of capital assets that have, built-in loss, and then there are, ordinary aspects of the business, ordinary income aspects of the business that you're selling. So that maybe you think, oh, everything should net out, but maybe it doesn't, and you end up owing a lot of tax on a transaction as well.
Mm-hmm. I have a question about advice. Have you ever run into a situation where the people you brought in to consult on a business sale, and maybe some of the other players in the game are they're just not offering good advice, right?
Mm-hmm.
From your perspective, A, have you ever run into that situation? And then B, like, what do you do in that case, right? How do you make sure that the outcome is beneficial to the client, but you don't want to like burn bridges or anything like any? Have you had that situation, and if so, like, how do you resolve it?
Yeah, we often have to burn bridges. It's so we go in with bazookas. I mean, it's we look at things. If things are wrong, we're open about it. If we have to talk to other advisors and protect our clients' interests, we do it. I mean, it's something that we regularly do because people have messed up in the past. Now there's a bill that's going to have to be paid. Who's going to pay it? Those are the uncomfortable conversations we often have to have in these cases. And certainly we have to press our clients' interests. So we just have to break things open and talk about it. I think, and maybe another thing to keep in mind with business sales is, just due diligence. It's not only about, hey, how much taxes are we going to pay, but has everything been done correctly? Often we see this with S corporations. There are a lot of things that will terminate an S corporation. So maybe you think you're selling an S corporation, but then when someone comes in to buy it, they ask for all this information, and they say, oh, look, this thing was not an S corporation; it was a C corporation this whole time, and now you have a huge mess. So, I think doing the due diligence is very important, and just being upfront, and that's how we operate now.
Yeah. Oftentimes my experience is that someone hires an accountant, financial advisor, an attorney when they're 30, and they become your friend, your social contact, and now you're 50 or 60, and you want to sell it, and there's enormous kind of peer pressure to keep those folks when in fact you should really bring in some folks that are sharper and a little bit more up to date on things. Do you run into that also?
Yeah, you can see both sides of it, right? Because the person who's been there for a long time, they know they know where all the bodies are, you know, they know everything, right? So it's sometimes bringing someone in new, fresh. There's a lot they have to get up to speed, and certainly there's a lot of cost involved into bringing someone new. So you know, there's usually a lot of hesitation to bring someone new in, but it is, you know, in these circumstances, it's good to have just a fresh set of eyes to look at things and just to make sure, because certainly if that person has been there a long time, they've done everything, and if they've overlooked something or they just missed something, I mean, hopefully not, but you know, there may be some interest in trying to sweep it under the rug or something. Whereas if you bring someone in fresh, they'll you know, they should look at it and
Right.
New eyes.
Right? Yeah.
Makes a lot of sense. Well, cool. We've covered a lot of material in this, Nick. I want to make sure people know how they can connect with you, and if there's anything else you should be really asking your tax attorney, just to make sure like deals go smoothly and you're not caught. Caught's the wrong word. Yeah, you're not. You don't find yourself in a bad situation.
Yeah, I mean, I think, you know, certainly having, I was discussing some of the due diligence. So if you're thinking about a sale, just not, you know, the tax aspect is great, but also the due diligence, making sure that everything is in place so that the business can be sold and that there are no liabilities lurking there for whoever purchases the business. And you don't end up in court 5 years later saying, you know, with someone saying, you sold me a bag of goods, right? So certainly the due diligence is important. And of course, I'm a taxable, so the taxes are important, and understanding what's going to happen and how much am I going to keep. That's always an important question. So how to reach me?
Yeah.
So our website, kimrosado.com, KIMROSADO.com. All our contact information is there. My email, nick@kimrosado.com. It's nick@kimrosado.com. Just feel free to reach out. If you're in this situation, if some of the things that we're talking about maybe, you know, raise some alarm bells or just makes you think that maybe this is worthwhile to have a discussion about, feel free to reach out, and you know, I'm happy to talk to you.
Wonderful, Nick. Thanks so much for coming on the show, and hopefully we can do one of these again in a little while.